So, Neelkanth, what should our viewers do? Our viewers look forward to your comments and how can they really implement it? Should Indian investor now get cautious because the run up in the Indian stock has been too much in terms of the connect with the world and with the real economy?
We have been advising caution now since August, September of last year, where we have been flagging that the markets will time correct. Short of a major global accident, I don't really expect a very sharp correction downward in the equity markets. It will be a grinding down of forward PE and the overall range of the Nifty or the BSE 100 remaining in a band. That's my current expectation. That's what I would uh, sort of narrate to your viewers as well. But within the market, I think there are opportunities. We still think that financials, though they have done very well and they are consensus at trade as you can expect, but given the improvement in forward earnings, given the lower risk of bad loans emerging in the next 12 months, uh, we we remain overweight that sector. We think sectors which are associated with an improvement in construction, of housing and real estate, um, like cement. I think those sectors still look attractive to us. We are cognizant that the current the theme of China opening up is pushing up commodity stocks. Our own view is that this improvement is going to be short term, and that there would be an opportunity to exit rather than build new positions. We also think that the IT services sector, which has very strong balance sheets, extremely good management, good cash payouts, good treatment of minority shareholders, is still a bit expensive for our comfort. And we would only be looking at entering that sector once management commentary on business outlook starts to become a bit cautious.
So, let's spend a minute on IT. The consensus view is that every time there has been a recession in the world, whether it was 2000 or 2008, it has impacted IT outsourcing. But the initial comments which we've got from Indian IT companies are that this time it is different, the cycles are longer, there are no deal cancellations, and what is happening to big tech, which is Alphabet, Microsoft, and Amazon, will not translate into reality for Indian IT. Would you take this management outlook with a grain of, with a bag full of salt, or you think there is reality in it?
It's a bit early. Remember that US unemployment at the last print was 3.7%. So the US economy, our markets have been worried about a potential recession now for several quarters now. But the US economy is still quite strong, right? The retail sales are above trend. There is a goods demand. The wage growth is still quite robust. You are seeing strong rental price increases. Remember that inflation is still 7.7%, right? So it's extraordinarily high by standards of what the US has seen over the prior 4 decades. So so I think the slowdown in the US economy is not very obvious yet, but higher rates and what the Fed's objectives are mean that over the next 6 months, the trajectory will be lower. And that's when some of the stress points start to become visible. Also, remember that the IT services firms are mostly about talent, and the pressure on talent domestically from the software as a service firms, as well as remember that if talent is more easily available in the US, given all the headcount cuts in big tech and the venture capital funded firms, means that there will be a lot more competition from US based firms as well. So the operating environment is going to deteriorate in the next, I would say, 6 to 9 months. And when the management starts to comment and starts to become observant or starts to see this in business flows, is the point at which I think the stocks would have started bottoming.
Just to wrap it up with one final comment, before we go forward, I'll take the clock back. November 2021, IT was enjoying a boom time. There was no fear of inflation. Everybody was convinced that interest rates will remain low for a long period of time, and financials and cyclicals were underperforming. 2022, financials are back on pedestal. Interest rates are likely to move higher. Recession is perhaps a fear which is back on the table, and IT stocks have taken a back seat. 2023, if you go forward, what could be the setup?
So it could be a tale of two halves. And remember that most of the developments that we have, and I don't want to sound like some of those talking heads which give general gyan, but most of the big developments tend to be break points, right? So COVID was one, the financial crisis was another, and so it's very hard to forecast something that everyone tries to avoid. So if you think about, say, the mortgage market in a country where that interest rate cliff is upcoming in the next 2 to 3 quarters, all regulators will be out with fire extinguishers trying to douse all fires, right? Some of the fires they may not be able to douse, and then there will be contagion effects which affect the rest of the world. So the risk of accidents is something that is very hard to quantify and say that this is the probability, because once the accident happens, then a lot of things change, right? Suddenly, dollar funding markets freeze. Countries with current account deficits can suffer much more than countries with current account surpluses, and India then becomes a lot more vulnerable. Indian demand will start becoming vulnerable. So it's very hard to think through a period which could actually be a break in the system. We will recover from that, right? So the world will then come together. We'll start to see some easing. Things will change, but you cannot look through some such development. So if that development has to happen, it will happen in the next maybe 6 to 9 months. If we have crossed those 9 months, then I would be much more positive on the domestic cyclicals, which we still are. And the expectation that the Indian economy is going to do far better than the rest of the world. Remember that even after the rebound that is expected in say retail sales in China post the relaxation of COVID restrictions, that process just started, right? So the expectation is that by second calendar quarter of next year, it will be reasonably open. The real estate cycle, in fact, one of the big findings of our demographic report was that as dependency ratios rise, the real house prices start to correct. And our apprehension is that near-term volatility in real estate stocks and real estate construction aside, the outlook, the 5-7 year outlook for real estate in China is not that strong based on the findings of our report. And what that suggests is that the rest of the world may not see as strong a growth as we had seen in the prior year. So our focus remains mostly on drivers of the Indian economy, and we would continue to expect the domestic cyclicals to outperform. But remember that there's a big caveat. We need to be cautious. In the last several months, we've added what we call the hunker down stocks, right? So the points at which we can seek safety in anticipation of a potential risk of a breakdown or a big accident in the global system.
Well, Neelkanth, really appreciate your time. So glad you could find time to join us. It's a Monday morning and it's a busy day with a lot of internal meetings. But the fact that you accommodated this interview request means a lot to us.
Thank you, Nubin. Thank you for inviting me. Pleasure talking.